The other week, the great food conglomerate Kraft Heinz, partially owned by Warren Buffett from the United States and partially owned by two billionaires from Brazil, made an offer of 143 billion US dollars to buy Unilever, another very, very large consumer company, food company, and to put it all together into one even larger conglomerate. The offer failed, Unilever rejected it, and it was withdrawn. I happened at the time to be in London when I talked with Paul Pullman, who is the CEO of Unilever and is one of the leading CEOs and chief executives who are concerned for sustainable development, sustainability, and having a notion that a business really needs to be socially responsible, that it serves more than just making a profit for its owners. It has to take care of its customers, its employees, its suppliers, the communities, and the environment. And Paul, I think, is widely recognized as having delivered on all these dimensions. He's delivered good profits for his owners, and he's delivered quality products for consumers. He's also paid attention, Unilever's paid attention not only to charities, but to small packaging, say in India, where people do not have a lot of money and they can't buy a big box of soap, but they can buy a small container of soap. In any case, when I was talking to Paul, the issue came up about for whom should a corporation exist? The classic argument is that a corporation exists for its owners, stockholders, shareholders, and the obligation of the board of directors, the fiduciary obligations of the board of directors are to take care of the owners. We at the Co-Roundtable have accepted this in part, but also pointed out that one of the fiduciary obligations to owners is taking due care, and that means if you're rational, you have to make sure you're serving your employees, you're serving your customers. If your employees are not engaged, if they're not working well to give a good product or good service, there's nothing you have to sell to consumers that they want to buy at the right price, so there's no way you can make profits for your owners. However, now, 2017, we have a couple of new dimensions to capitalism. First of all is the significant change which has taken place in financial markets, stock trading. It comes down to basically stocks are bought and sold, they're traded. They're not really owned for the long term. People buy and sell. Sometimes with computer trading, stocks are owned for a fraction of a second. Someone who owns a stock for a fraction of a second, I submit, really doesn't think long term about the value of that corporation to the owners in the long run, to the community, to the society, to the consumers. They just want a legal right which they can sell and trade in order to make a short-term profit. They want to cash out immediately. They're not really concerned about the capital appreciation over time of the company, of the total capitalization, because that's going to happen sometime in the future. The two are linked together because they need to have that company having some future so that somebody else will buy and they will try to get closer to that future value. But the owner today just wants to sell out, or they want to short sell. Funds who are holding monies for retirement accounts or pensions or long term, they're also in the market and they have to go in and out of the market. They have to buy and sell in order to maximize their profits. Financial decisions are often supported by debt. We saw in the collapse of credit markets in 2008 that short-term borrowing to buy stocks is a way you can make a lot of money, but then when the markets get rattled, companies like Bear Stearns and Lehman Brothers can't borrow in the short-term market, and so they collapse. They have too much debt, not enough assets. So what's going on? The question is, should we rethink what a stock is, what ownership is? Maybe things have gotten more complicated than they were in the 19th century when our basic notion of ownership in corporations was framed. And that was the notion of a person who would buy a share of stock and hold it for a long, long time, basically, and who cared about the long-term prospects, the survivability, the sustainability of the company. I think it's a fair assumption today that most owners of shares don't really think too much about the company and its earnings. They want to make money by selling the shares to somebody else. In line with this, we have the recent public offering of shares in Snap. This is the parent company of Snapchat, which has been a very successful company offering an app mostly used by young people, which they can use to send messages and photographs with the particular feature of these things disappear, so that you can say something which maybe in retrospect might embarrass you, but you don't have to worry about it because it'll disappear. In any case, this company is attracting a lot of usage for its app. It can sell advertising, it can make a lot of money. However, it's issuing its shares with no voting rights. In other words, the people who spent billions of dollars to buy shares in Snap just last week did not buy any right to control the future of the company. All they bought was basically some chips for a poker game. They bought some legal rights that they could sell to somebody else. And other people, by the way, were interested in these legal rights. They were interested in buying the shares, and so they would buy them. So if you bought the shares in the initial offering and you turned around 2, 3, 4 hours later, you could sell at a profit. You could cash out. Snap said in its prospectus, on page 48 of its prospectus, that it has no intention of paying dividends. What that means is that in this company, all the profits it makes are not going to be shared with quote-unquote owners. They're going to be shared with the people who have a long-term stake in the company. That's a different group of people who have voting rights, which is a very, very small group of people, the founders and their close associates, who are the real owners of the company. Not all the people who are trading the shares or who are owning the shares which could be traded in the stock markets. So there are two different classes of stock. There's a trading stock and then there's an ownership stock. I think Snap, and by the way, Facebook and Alibaba have similar two-tier ownership structures. Many companies do. For decades, Microsoft didn't pay any dividends, and its stock kept going up and up and up and up. People wanted to buy the stock. They wanted to get on the escalator, even though they were going to get no cash from the company. They were going to get their cash from other players in the market. In this new world, I think we really have to think about who owns a company and what do they deserve.